All right, and here we have it. Marcus Mitchell of Shire Capital Management here with us today to talk about, well, let's just jump right in. So you buy a farm, or you buy the land, you help the operator grow their revenue.
Yeah.
Mm. It's it's not going to like 100x like a tech company would or
No, no.
50x overnight. Um, but
Maybe over 30 or 40 years, but
Yeah, yeah, exactly. So it's when people are thinking about where to invest their money, like maybe they do dabble a little bit of this, a little bit of that. When they allocate funds to someone like you and trust you with their funds, what are they expecting in their investment in terms of risk and opportunity?
yeah, no, it's a really great way to think about it. What is the risk reward? And we've always thought about it as basically being that's kind of like a triple threat. Like your downside scenario is you own land, right? So land has a very, very long history of preserving capital. I mean, if you go to Stats Canada and look at their farmland index, the average rate of appreciation on land since 1950, about 7% per year. So, they don't report on rents, but like let's just say 3% is like a bogey number. You could count on over that, 70-year period, give or take. You're looking at 10-ish% is your kind of expected return to own land over the long term. And there's that varies as good periods and bad periods, but generally there's very few periods where there have been drawdowns where you've really kind of like had the values decrease dramatically because it's scarce, right? And it's tightly held, and farmers don't panic sell their land. That's the reality, and um, that's kind of how we think about it as a base case. Like you own land, it's had this long term of performance. Our middle case is we're successful in kind of consolidating and operationalizing and improving these assets. So they're generating really attractive cash flow that we like to focus on. So we like to buy farmland assets, and we like to participate in the production and sales of those products. And we target cash on cash generation 6 to 8% is kind of how we think about it. So that's quite a bit higher than what you will generally find with bare row crop farmland investments. I mean, I would say most might have like a 2% cap rate in this environment if you're buying in Ontario, and maybe a little bit higher in the prairies, but that's generally true. Um, so like the middle case is you have this nice asset that can kick off really nice cash flow for the risk. And then the upside, and this is really what we're trying to do. And I think our first partnership was a perfect example of this. So there's quite a lot of interest from pension plans, family offices to allocate to this space. It's become more in vogue over the last 15 years since the GFC, for the reasons
Now,
I mentioned. I mean,
is this farm sector in general or your specific niche or both?
I would say the farm sector in general, like agriculture as an investment strategy, farmland as an investment strategy, of which permanent crops and our focus is a sub niche. I would say it's one that's interesting to folks because I think a lot of people can emotionally or personally relate to the idea of healthy food production. I would say like the vast majority of people who end up talking to us are like they got there because they had some intuition, they wanted to own farmland, and they are interested in health and food and the food system. So someone says talk to Marcus because that's kind of what he focuses on. They're like, oh, I get it. Like this is a way I can kind of combine the Venn diagram. I want the farmland, I want the risk return profile, but I like the values overlay of health and food, and I think that's really cool.